Hi, good morning, everyone. Thanks for joining the weekly research morning call. Today we have some stock counter updates such as specific Radiance, Q&M, and LHN. Some sector outlook like banking monthly, risk monthly, aviation monthly, and as usual there will be technical analysis and Singapore weekly. Yeah, so this is our usual disclaimer. Basically, the webinar is for educational purpose only. Yeah, so without further ado, I'll hand over to Glenn for Banking Monthly. Glenn, please.
Hey, thanks, Mel. Yeah, so we just start off the Banking Monthly with the fourth quarter results review. I did go through this a few weeks ago, but just let me do a quick recap. Just basically, for the banks, the net interest income and net interest margins were down, with the exception of DBS. This is sort of expected for it to decline because of the declining interest rates. But for DBS, why they did outperform in terms of net interest income, net interest margin was mainly due to the fact that they do have the highest sort of proportion and amount of excess deposits, as well as the current account and savings accounts. So they were also able to move these deposits into sort of longer tenure interest earning assets, which is why their net interest income did benefit from this. While the other two banks were mainly their net interest margins, net interest income comes from loan yields. So if the loan growth is not as strong, or if interest rates are down, then the spread they earn isn't as high. But what's similar, at least for most of the banks, was that the non-interest income, like the fee income and trading income, was what sort of bumped up their earnings, right? So if you look at DBS and OCBC, they did continue to have double-digit growth in fee income. UOB is outlier here, mainly due to the fact that they had some issues with trying to transition their CT assets. So I think the last quarter and this quarter, it just wasn't as strong. But if you're looking into next year, which I'll go into more detail later, they are forecasting for better growth, once, because now everything has been consolidated and everything has been integrated well into their platform. For allowances wise, it was also up, also expected, but it's still within their guidance, their credit cost guidance. Likewise, all three banks have quite high management overlays, which they will be able to sort of offset and write back some general provisions if the specific provisions come in higher. And that's how they are able to maintain their allowances as well as their credit costs. I think the most important one, which a lot of investors are looking at now, would be the bottom red bar here, and that is the dividend yield. So this is our forecasted dividend yield, which includes the capital distribution that all three banks have announced. So all three banks have announced some form of capital distribution, but it's all really quite similar. They are essentially just giving additional dividends, right? And also a share buyback over the next 2 years, so two to 3 years. Yeah, so it's up to 2026. So 2025 and 26, they'll be distributing a lot of their capital back. And based on that, we have forecasted dividend yields at around 6.1 to 6.5%. Yeah, so their dividend yields are still very attractive. Sorry, go back to the previous slide. Yeah, so for our top pick amongst the three banks, it would be UOB. Because we do expect the highest earnings growth from them for FY25, we're expecting around 12% growth, year-on-year growth. And this is coming really from more substantial fees, trading income, as well as loan growth recovery, while their net interest income and net interest margins will remain quite stable. And our forecasted dividend yield of 6.5% is also the highest, or at least on par with DBS, right? And we also believe that they can continue to pay out these special dividends of 50 cents per share for at least 2 more years, so additional 2 years to reach their optimal CET1 ratio of 14%. So that's all for the recap. Now let me move on to the usual stuff, which will be starting off first with the interest rates. So for interest rates, Singapore interest rates were down 13 basis points month-on-month to 2.82%. And this is the lowest that we have seen it reach since November 2022. So the lowest in almost 3 years. And it also fell by 82 basis points year-on-year. As for the year-on-year decline, this is also the most significant year-on-year decline since February of 2021. We do expect that the 3-month SORA will continue to decline as more Fed rate cuts are expected. As for the Hong Kong interest rates, a similar story. They were also down in February, down by 9 basis points month on month and 78 basis points year on year. We also do expect that it will continue to trend downwards following the Fed rate cuts. Now, moving on to the loans growth. So for something more positive would be the loans growth. It had reached 28-month high in January, reaching 5.3% year-on-year growth. And this is an increase from the previous month's growth of 5.2%. So for FY25, we do expect this to maintain. We do expect mid-single digit loans growth for 2025, as the loans growth is expected to recover further from additional rate cuts anticipated for the year. So, while rates are declining, the net interest margins are declining, at least the loans growth will sort of offset some of that decline, and net interest income will remain relatively stable. For the bank's guidance, they are guiding for mid to high single digit loans growth. UOB is really the only bank that is guiding for higher single digit kind of loan growth. Business loans wise, it was up by 6% year on year, mainly due to improvement in the building and construction, as well as a recovery in the manufacturing segment, which finally did a turnaround and rose by 2% in January. So this is the first year-on-year increase that we have seen in the manufacturing segment show since December 2022. So about 2.5 years, 3 years, they have been in a continuous decline. Consumer loans was also, quite stable, growing by 4%, mainly from the housing loans, which was up 3% and it has been relatively stable. For total deposits and balances, it rose by 6% year on year, and more importantly, the current account and savings account or CASA proportion rose slightly to 18.6%. We do expect that this CASA ratio will continue to increase as the higher interest fixed deposits mature and the funds get shifted back to CASA. So this is very important for the banks because the CASA is essentially like free funding or very low cost of funds for the banks, and they can take this CASA, they can either put it back to loans, give back loans, or they can also put it back into sort of interest earning assets, and that's why the CASA ratio is very important. The higher it is, the lower the cost of funds it is for the banks. Okay, now moving on to the next slide, we're looking at the SGX statistics. So in February, it was healthy. We saw a continuation of the volumes growth from January. So January and February were quite good months. SDAV was up 18% year on year, while DDAV was up 8% year on year. And this is really attributed to the continued sort of high volatility. So we use the VIX, which is the market index that measures the implied volatility of the S&P 500, and it averaged 17 in February, which was slightly higher than January 16.8. We do believe that this heightened volatility will persist at least into the rest of the first half of the year, and possibly into the rest of the year, as particularly under this Trump administration, which will boost volatility and in turn also benefit both the SDAV and the DDAV. For the top 4 equity index futures turnover, it rose by 8% year on year, mainly due to the recovery in the FTSE China A50 index futures volumes. Now moving on to the next slide, looking at the bank's share price performance, it was quite mixed in February. If you compare on average, it only rose by 1%. And this muted performance was really due to the less than optimistic earning outlook in FY25. So if you compare across the 3 banks, right, UOB is really the only one that, which is why it's also our pick, right? It's the only one that we can see some strong earnings growth, right? A double-digit earnings growth. For OCBC, it's very low single-digit kind of earnings growth for 2025. And for DBS, because they are really hit quite hard by that global minimum tax average of 15%, they are looking at a slight decline in earnings growth. So if you look across the board, the dividend yield is the only one that is still propping up the bank's share price, right? And also mainly due to the capital returns initiatives that they have given out. Otherwise, UOB is really the only one that we see some form of growth. Yeah. So that's all for the next slide. Yeah, so that's all for the banking monthly. We do maintain an overweight, and we do expect that with low rate cut expectations entering the rest of 2025, as well as a rising yield curve, the banks can earn more interest on loans than on deposits, and this will boost their net interest incomes as well as their net interest margins. And also the rise in the trading volumes, the capital markets have turned to more buoyant in the fourth quarter, and we expect this will continue to benefit the banks going into the rest of 2025. So that's all for the banks. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. Yeah, I'll run through the REITs monthly. So this is a recap of the share price performance last month. Yeah, so you can see overseas commercial for the month, it's down 10%. That's mainly because of the US listed office REITs. Like Manulife was down 23% as their financial metrics remain stretched, and yeah, their FI performance wasn't too great. And the best performer was actually overseas retail. Retail specifically, Paragon REIT performed exceptionally well. That's because they had the offer, the proposed privatization offer at 98 cents. So as a result, last month their share price rose 9%. Yep, and the REIT index is still down 2.9% last month, and year to date is down 2.8%. Because January was slightly up by 0.2% flat. Yeah, so that's just a recap of the share price performance so far this year. Next slide, please. Yeah, so after the share price performance, we saw the 10-year dividend yield spread, it rose towards the 10-year average. So now it's at 3.8%. So that is at the 10-year average. That's mainly because of two factors, the share price performance, like I mentioned, as well as the fact that the 10-year yield has fallen. So the 10-year yield fell 18 basis point month on month. And how do we interpret this chart? Basically, it's just how much when you invest in REITs, you are getting the premium over the 10-year risk-free rate, or so-called a fixed deposit rate proxy. So how much more dividend yield you are getting as compared to that, the proxy of the risk-free rate. So as this so-called the yield spread increases, it's more attractive to invest in REITs as compared to the Singapore risk-free 10-year yield. And rather you are being compensated more for investing in the riskier asset REITs than the risk-free rate. Yeah, so this as this increases, it will look more attractive to invest in REITs. Yeah, next slide, please. Yeah, so on the left-hand chart, that is the forward dividend yield. So we saw the forward dividend yield, it rose, and now it's at 6.6%. So that's at 1 times standard deviations above the mean. Partially it's because of the share price performance as well. The share price is weak. But the forward dividend yield, we expect that to continue to improve, especially from the absolute number of DPU. We expect that to start increasing this year. So we expect about on average about 1% DPU growth. So 50% of the listed REITs are expected to start benefiting from lower interest rates this year. And the majority or rather the remaining will start benefiting next year in 2026 from the interest rate cuts. So as a result, the absolute number of DPU will very likely increase, and as a result, this forward dividend yield will start to increase as well, assuming share prices remain constant. And on the right hand side is the S-REITs price to NAV chart. So now you see at 0.83 times, so that's even below COVID-19 lows and below and around the lowest it's been in the past 10 years. So now it's at -2 standard deviations. So we think at these prices, the valuations are cheap for REITs, and think it's a good time considering that now the market is pricing in 3 more rate cuts in 2025. The Fed is projecting 2 rate cuts, but the market is pricing in 3. So that's still a good sign, and it's possible for recovery, especially with more rate cuts. Yeah. One more thing to note is that last month, the Reserve Bank of Australia, so the RBA, they cut their cash rate by 25 basis points to 4.1%. So that's the first cut since November 2024. And that will start benefiting the REITs with Australian exposure. So the highest exposure now for Australia is FLCT. It's about a 46% exposure, and AIMS back with a 32% exposure. So those two REITs will start benefiting from the Australian rate cuts. But to look at cap rate compression, that is still too early to say. So we do not expect any cap rate compression yet for Australia, but at least they'll benefit from the loans side of things. Yep, and just to note that the Bank of England also they cut rates last month by 25 basis point to 4.5%. And yeah, the Fed over last week they held the rate steady at 4.25 to 4.5%. Yeah, next slide please. So we move on to our subsector preferences. We still favor retail the most because of its potential for higher rental reversions. So looking at this chart, the RSI X motor sales. So we saw RSI for January is up 4.8%. So that is a recovery after the 4% decline in December. But that's mainly due to the fact that Chinese New Year was celebrated in January last year as compared to, or rather January this year compared to celebrated in February last year. So as a result, the RSI spiked quite a bit. And we continue to monitor this, but generally the sentiment we get from landlords and tenants is that the tenants are willing to pay higher rents, mainly because Singapore's status as global story and tourist and business hub, it continues to attract strong interest from these retailers. And occupancy cost is still below historical average and below pre-pandemic averages as well. So there is potential for higher rents as well. Yeah, and also the limited supply of new incoming retail space is also very low. It's like less than 1% of the supply. So all these factors will help to boost retail rents. So we're expecting high single digit, at least positive rent reversion for our retail sector this year. Yep, and one more thing is also the improvement in international visitor arrivals. Next slide, please. So the improvement in the visitor arrivals will also help retail spending as more visitors spend at the suburban malls especially. And yep, so this chart it shows that the RevPAR grew 6.5% year on year. So that's a very positive sign because originally we were expecting RevPAR to be quite weak in first quarter because first quarter last year it had Coldplay and Taylor Swift concert. So because of that, we're expecting the hotel RevPAR to actually be flat or maybe even decline this year in the first quarter. But so far in January, it grew 6.5%. So that was a surprise to us. It's mainly because of higher hotel occupancy, 4.3% increase. So we are monitoring this situation to see how strong this RevPAR can be this year. So the month to take note of is March, because March last year was the Taylor Swift concert. Taylor Swift concert was different from Coldplay because Coldplay it wasn't an exclusive concert in Singapore, but for Taylor Swift it's exclusive in Asia only. It was exclusive in Asia, so as a result, we saw a lot of foreign demand. Coldplay not so much foreign demand, but there's still foreign demand because it wasn't exclusive basically. Yeah. So if March numbers are still good and we still see perhaps a RevPAR growth in March, so the outlook for RevPAR will be much higher, or our outlook will be stronger this year, especially from the improvement in the visitor arrivals, which are now only 3% below pre-COVID levels. Yeah, and we expect it to be about 95% to about 100% of pre-COVID levels for international visitor arrivals. Yeah, RevPAR numbers, despite the 6.5%, not say very high, it's slowed from the high base in 2023. I mean, from the low base in 2023, the growth has slowed, but it's still already 17% above pre-COVID levels. Yep, and going forward for rest of this year, there are some bright spots in to attract tourism, like the Minion World in USS. So that's been completed already, as well as the expansion of Sea Oceanarium, and perhaps even the Lady Gaga concert in second quarter. The demand is not as strong as Coldplay and Taylor Swift for sure, but at least it might help bring some foreigners, as it is still a Singapore exclusive concert. So it's the only concert that she's going to play in Asia. So yeah, there might be some demand there as well. So RevPAR, so hospitality sector is still looking quite okay this year, but the growth is not as strong as the 2023 and 2024 for Singapore. Yep. Next slide, please. Yeah, so this is our coverage list. One thing to highlight here is that Lendlease Global, they will redeem their $200 million 5.25% perp in April. So that is the next call date in April 2025, 11 April. So they've already issued a new perp, 120 million. So that will partially offset the new, or rather the perps that they're going to redeem. So the new perp that they issue is at 4.75%. So that's a 50 basis point savings. Yeah, so the thing for them is that because their ICR now is at 1.5 times, so by issuing a lower coupon perp, so they will have some interest savings there, and that could help to minimize the risk of them reaching the 1.5 times adjusted ICR. Yeah, and the lower perp coupon, it just shows a better market conditions as interest rates have come down, and better liquidity conditions as well. So yeah, so Lendlease, they are trading very close to their 1.5 time ICR, which we are still monitoring the situation. Yeah, another one is AIMS APAC REIT. They also issued a new perp, so that is a 4.7%. It's the same quantum as the one that is of the current perp that they have, which is expiring on 14 August. But the current perp that they have is at a 5.65%. So they issued a 4.7%. So it will result in some, or rather 95 basis points in interest savings for them if they use these proceeds to just redeem the perp that is outstanding, which we think they will do so. Yeah, so that is all for me. I'll hand over time to Yao. Thanks.
Yeah, thanks, Darren. Yeah, so I'll go through Singapore Air Transportation Monthly. Yeah, so in February 2025, aviation industry demonstrated a range of outcomes, like CAL decreased by 9.1% month on month, as gross margin for its trading business in second half 24 deteriorated, and also its dividend payout ratio fall short of expectation. And SaaS also continued its downward trajectory due to the flip-flopping tariff. And SIA was the top performer, which gained 5.1% year-on-year. And air travel demand remained resilient. SIA reported a 0.5% year-on-year increase in passenger traffic, which is surpassing the 0.2% growth in capacity. Yeah, so as a result, passenger load factor increased by 0.2 percentage point year-on-year to 86.5%. And this is continued to outpacing pre-COVID level. However, cargo volume is still declining. Yeah, the load factor continued its downward trend and declined by 4.8 percentage point year-on-year, as America and also Europe contracted by 11.2 percentage point and 13.8 percentage point respectively. And this is mainly due to tariff. And some observation for aviation industry for the past months. Basically, like major US airlines have highlighted that there's a weakening in demand, and it's mainly driven by the reduced travel from government employees and also consumer uncertainties over the US macroeconomic outlook. And also to adding on pressure, Canadian travelers to the US has also declined sharply due to the trade tension over tariff. And new bookings from Canada to the US declined by 20% year-on-year since February. And this has forced the airlines to adjust its capacity due to dropping traffic. Yeah, so around 10% decrease in Canadian visitors could potentially result in a 2.1 billion loss in spending for the US. And the trend also expand beyond Canada, which travelers like from Denmark and Germany, saying 27% and 15% year-on-year decline. Yeah, and the overall demand from Europe declined by only 1%. Yeah, so this is pretty marginal. And for outlook, we do not expect the spillover effect to significantly impact SAA, since US only accounts for around 7% of the total revenue in FY24. However, the broader economic impact from the US, this will influence the business sentiment and also probably corporate traveling budget for Asia companies. Yeah, and we do expect yield to continue to trend down due to several factors. So on the demand side, we observe a softening macro economy, which tend to hinder discretionary spending growth. And also, according to IATA, 70% of the passenger actually prefer to pay the lowest fares. Yeah, and on the supply side, Asian airlines had the most aggressive capacity expansion plans, which capacity increased by 17% year-on-year. And compared to like other regions such as Europe and North America, where capacity only increased by 0.2% year-on-year and 6.2% year-on-year and 0.6% year-on-year. Yeah, so overall we maintain neutral to Singapore air transportation sector. And that's all for me. I'll hand over to Bing for technical pause.
Thanks, Melvin. Good morning, everyone. So first up, I'll talk about S&P 500. Last week, it had the first week of rebound, up 0.5% for the week after 4 consecutive weeks of decline. So a bit of stabilization for the index, a bit of a higher low around 5,600 form and trading sideways for the rest of the week. Positive thing for now is that index is holding above 5 and 10 short-term SMA levels. So I think we could see some further rebound this week to retest the 200-day SMA breakdown. That's around 5,750 level now, as well as the uptrend channel breakdown in blue, which is around closer to 5,800. Index could be possibly trading in a bearish flag highlighted in orange in the chart as well. So for now, resistance is largely at 5,715 to 5,850 area, and support at 5,560 to 5,630 area. Next slide. Then next one, I'll touch on the Hang Seng. So Hang Seng last week was down for the second consecutive week, down 1.1% for the week itself. So I think currently it's trading within this short-term uptrend channel, as well as holding at the 20 SMA support level. However, there could be a potential breakdown, which could see further weakness ahead, because price actually formed a double top around 24,700 level. Also, we see bearish divergence and declining momentum on the MACD and RSI indicators. So with that, should we break down, the next short-term support level will be around 22,500 to about 23,300 level, which is around the 38.2% Fibonacci retracement level if you take the swing low formed in January to the swing high form recently. And resistance will be around 24,000 to about 24,400 area. Next slide. Next one, we have a technical buy stop for DFI Retail Group at $2.30. Take profit levels at $2.34, as well as $2.54. Stop loss at $2.13, and last close was $2.25 on Friday. So we adjusted our TP as well as stop loss 7 cents lower in account for the XD that happened last week. So for DFI, there was a breakout of a downtrend channel in blue in the chart. This was after the chart formed a double bottom at the $2 level and recovered back over $2.13 level. That after which it formed a bull flag, and the short-term holding above the short-term moving average like the 5 and 10 SMAs, which is above the 20-day SMA as well. So with that, possible for the recent momentum to carry on to do a further rebound towards these two take profit levels. Next slide. Next one is a technical buy for Geo Energy Resources at 31.5 cents. Take profit levels at 37 cents and 39.5 cents. Loss at 29 cents. Last close was 31.5 cents on Friday. So Geo Energy has been trading sideways in the ascending triangle formation, with the key resistance at 30.5 cents since August of last year, and it broke out recently in the middle of this month on high volume. Price is also trading holding above the 5 and 10-day SMAs, short-term MA supports as well recently, increasing momentum at MACD, the MACD line at its highest since October of last year. So with that, if you can hold above this current breakout, we could see some further upside towards these two take profit levels, which were prior resistances in the past. Next slide. Yeah, so just to summarize, the two trades initiated for DFI is currently in progress. It's up 0.8%. For Geo Energy, it's in progress as well. It's currently flat as of Friday's close. So that's all from me. I'll hand over time to Paul to talk about Pacific Radiance results. Thanks.
thanks, Zane. So we just move on to some of the reports that I did a few days ago, but just I was away for leave, so didn't have time to present. So the first one will be Pacific Radiance. I think that, as the title suggests, the turnaround is still is underway. If you look at the results, it was about 65% of our full year, but this is due to some upfront expenses. This is just a few $100,000 difference, so that's why you see this only 65%, because they had to do some retrofitting of the accommodation barge. So this is the accommodation barge where they secured a $31 million contract from the Middle East. The positive was that all divisions are performing well. So if you look at the shipyard, so the shipyard is mainly repair work. So they did, from 60 vessels in 23, they did 100 vessels of repair work in 2024. So that supported the 48% growth in revenue. Ship management was 75, mainly because there is some new ship chartering revenue that came in. So they basically turned around. They added 3 vessels, 1 workboat, 1 AHTS, and 1 accommodation barge, which I just mentioned. But most of them especially the accommodation barge, all came in quite late, probably in the 4th quarter, November timeframe. So that's why you get this big jump in ship chartering, in ship management, which includes ship chartering. The negative is just the weaker gross margins. Again, this is mainly because they had to spend some additional money to get the accommodation barge ready. We maintain our FY25 earnings, our buy recommendation. So for 2025, the turnaround is intact. So you already see that in the second half, they were loss making of 1 million. Then second half they made $3 million US. Sorry, it's not SGD. Sorry, it's US dollar. Then the turnaround will be coming from the 3 vessels that will get the full year contribution: 1 workboat, 1 AHTS, and 1 accommodation barge. They are also constructing 2 CTVs. So these are CTVs. They're basically like some similar to Marco Polo. So CTVs basically transport people to all these offshore wind farm installation. It's virtually like a taxi. Let's think of it, of a nearshore taxi. They will bring people to the offshore wind farm. So just think of that way. They have 2 being constructed, and if they can sell, then it will contribute to their 2025 earnings. There's also a turnaround in their associate Logindo. I think Logindo has about 40 vessels, but they also face this huge debt restructuring, which Pacific Radiance had to undergo. And you can see that they turn around to 1 million profit in the second half. And of course, the usual growth in the ship repair work. The company, I think at the peak during the 2016, I think their net debt was probably 400 million, if I'm not mistaken. Now that's turned around to a net cash balance sheet of 18 million, which will allow the company Biting to also expand its current fleet size. So not only these three vessels, sorry, the target price is 6 cents. Yeah, sorry. Oh, must have been too sleepy. The target price is 6 cents. The last is 4.5 cents. Yeah, my apologies for that. Yeah, and that will allow them to expand the current fleet size. Yeah. They also at the table at the very bottom, they announced their first dividend in, I think, nine years. Yeah, after completing the debt restructuring, which is about 1.6 cents or 0.16 cents. Yeah. Next slide. Okay, for Q&M, if you go back to the title, for them, the last 2 years, I think Q&M has been doing some major reorganization for future growth. So that's the main point. Next slide. If you look at the results, the earnings was above our expectations, 113 to our forecast. They also announced a second interim, which is technically a final dividend, but you don't have to go through a shareholders vote. I mean, you call it second interim dividend. You just can pay immediately. So that was up 32%. And they announced, I think, the first time, a 50 million share buyback. The positive was the group earnings. So we say group because it was across the board. Not so much dental per se. Dental had some better profits, but it was because if you look on the left here, they sold their EM2 AI. So EM2 AI, for those who may not know, they started this, I think, 2018, if I'm not mistaken, to develop software whereby if a patient goes in, you can have a X-ray. They call it OM. They have an X-ray of your teeth, and then from there they can detect all the problems and give a recommendation. OPG, sorry, called OPG. So that was loss making almost 2 million 2023, but the losses have narrowed, and they also sold part of it as an associate stake. So that was also, and also the associates did well. You notice the turnaround from, although a small amount, 291 to 120, but at least it's still a turnaround, which is the Alcin associates. And yeah, the negative is that the dental revenue, you notice the core dental revenue fell about 2% in the table on the left in under the comments part. The group went down 4% because they disposed of Acumen, if you recall, the COVID-19 test kit, so that the laboratory was losing money, so they also disposed that. The softer dental revenue was in part because they relocated 4 of the loss-making or non-profitable or loss-making clinics and reopened 5. So because of that, the dental clinic was affected. So if you look at our outlook, we raised our earnings on the back of the turnaround in the EM2AI and also housing, and also they are improving the profitability of existing clinics. You can't see it now because there's a big reshuffling, but we think the profitability will improve. We maintain our buy recommendation. We raise our target price mainly because we're pushing it to FY25 earnings, which is higher than FY24. The upside to earnings is, I think the company is probably going to pursue some aggressive acquisition strategy, especially in China, I believe. And also, if EM2AI can complete their agreement to distribute their software in 1,000 clinics in the region, then that will be also another additional earnings driver for the company. Next slide. So I'll move on to LHN, a year of harvesting, because we think this year maybe earnings growth may not be as strong as in the past, but it will be a lot of asset disposals and hopefully some special dividends. The next slide. So for them, they gave a 1 quarter 25 update. There was no financials, there was no revenue, nothing. They just gave operationally that for us, they just mainly give the occupancy rate, which is above 95% for all the properties. So you can just think of it as basically fully occupied most of the. For the co-living business, they only added 45 keys. There's this 29 facilities mentioned, but that's small. And they also launched their food factory, which will be like a one-off property development project. And they are trying to sell the 49 units. The key business the key growth business now is a co-living, so that is doing well. They added only 45 keys, but the occupancy remains strong. They are expanding by this year, should be 151 keys. But next 2 years will be stronger because they are going to add 210 in Middle Road, another 150 keys. And the other one, they park under co-living, which is healthcare accommodation. This is essentially nurses. So the MOH is trying to bring in more and more nurses from abroad and parking them into, I wouldn't call it dorms. I mean, they're better conditioned than dorm. I wouldn't say better conditioned, but they are better, well equipped with services and so forth for nurses. So they secured their first contract, if you recall, in January of last year. Although it's 350 beds, but they actually bill on the number of head counts, so about 700. And they are looking for more. So maybe this year they could get another contract. And for this, a lot of dorm operators can't get into this business because you need to have a co-living kind of experience, because you need to have a community engagement, more activities. Yeah, so you can't run it like a normal workers' dorm. Yeah, so that's why I think companies like Centurion could not get into this space. We maintain our earnings, our target price, our buy recommendation. So for this year, we think there'll be several monetization efforts. There are 3 properties, co-living properties or co-live properties they're trying to dispose and lease back and get some gains on it, because they want to be a bit more asset-light, and then potentially Golden Mile car park and block, and then the unit sales. If all this happens, I would assume they will do some special dividends. Next slide. I'll move on to our usual weekly update. So for this, there was some news on new home sales, which continues to be very robust. February, of course, there's a lot of seasonality because depending on whether there's Chinese New Year, no Chinese New Year, but I think the property market's so hot, it doesn't really matter. Year to date, about the number of property units sold was about 456% year on year. Some incredible number jump. Singapore exports continue to be resilient. I wouldn't say very strong, but at least resilient. +2. Electronics is the one that's strong. In China, they released some data points. The property sales is actually stabilizing, or at least not contracting as much as before. But retail sales continues to be still sluggish. So in general, I think although the China Hong Kong market rallying, but just be a bit more mindful that the economic conditions are, I wouldn't say robust, just stable, which is, I guess, good enough. US had some retail sales. I know there's a bit of worry that household surveys were down. There was a consumer confidence were down, but in terms of retail spending in the US, if you exclude the volatile motor vehicles and if you exclude gas, because gas, depending on, is affected by oil prices. So we want to strip that away to get a cleaner number of retail sales. That is actually still quite healthy at 3%. That is even better than Singapore. And ours had GST, right? This generally still healthy considering in the US, there was very extreme weather, the cold weather in January of 25. I mean, you want to do some day statistics, is the coldest since 1988. There was snowstorms in the US, there was Arctic freeze, but the retail still held up. So actually, the consumer spending is still quite resilient in the US. Next slide. Move on to some of the key news. So the key one is a FOMC meeting that we had. We all know that the Fed didn't change any interest rate; they kept it intact. But the whole press release, I think he keep on mentioning the word uncertainty. I think like 16 times. So Jerome Powell said that environment uncertain, outlook uncertain, household business survey uncertain, their trade policy, everything is uncertain. But anyway. But what they did was they actually lowered their growth forecast for the US and raised their inflation expectations for the US. So essentially stagflation, which is the worst of both things, right? So stagflation means inflation higher and then growth slower, which is the worst of everything. I mean, it's like the worst thing you want to have for our economy. But the market celebrated because and the bond yields, I think, went up maybe 6 basis points because of the dovish tone. So the dot plot still shows two interest rate cuts for 2025. That's what the Federal Reserve expect. And even though there's tariffs, he says that no, even though there's tariffs, any inflation caused by tariff is temporary. So which means he's a dovish. That means any jump in inflation is not to be a big issue for him. The other thing is that the Federal Reserve is slowing QT. So what it means is that they let the bonds mature, but basically they are not selling so many bonds. They are actually, instead of selling 25 billion, they are actually now selling 5 billion. So the main thing now, which is 2nd of April, which Donald Trump calls the Liberation Day. So that's the one that all the markets will be on hold because we're not sure which countries are going to be hit by tariffs, reciprocal tariffs, but the Treasury Secretary did say that there's this they call it the Dirty 15. I mean, they keep on coming with new names, but the new name to learn now is called the Dirty 15. So these are the 15 countries will be slapped with high tariff walls, high tariffs. Not sure which countries, but those that Trump has mentioned before include, of course, Canada, Mexico, China. Then we have India, we have even Kuwait was mentioned before. South Korea too. So these are the countries that should be a bit more worried because they did mention their names. But we think all this reciprocal is actually fake because to be reciprocal means it's free trade, right? Reciprocal means if you don't charge me tariff, I don't charge you, which is actually the free trade agreements were already reciprocal because it means there's nobody charge anybody any tariff or taxes. So that's reciprocal. But I think the problem we have now is Trump's policy is more discretionary. So they said that it's not only just tariff, you might have, if you impose on US goods tariff, barriers, non-tariff, if you have unfair funding, I'm not sure what that means, labor suppression, which obviously they're going to blame China, could even blame Vietnam, or if you manipulate your currency, which they mentioned Singapore could manipulate currency before. So any of these things also, they will, because of all this, they're going to impose tariffs on you. So I mean, they just make it up as they go along. So that is the worry we will have on the 2nd of April, which hopefully it doesn't impact Vietnam or Malaysia, or even if it does, our tariffs might still be lower than what's being imposed on China. Yeah. And also, there's also some thoughts that after this is the overhang and the market could rally, which I'm not sure. I mean, it depends on how extended this trade war becomes. Because don't forget okay, then if we move on, the worry we have is global growth shock, because tariffs are like a consumption tax. It will just make everything more expensive. It's like you buy wine, then suddenly now become 20% tariff. So everything become expensive, then people will consume less. So higher taxes will pull down demand by corporates, pull down demand by consumers. And do note that no, US is also a big exporter. US is the second largest exporter, so their economy will also be affected. But of course, the worst hit will be the countries like Mexico, Canada. They will be the worst hit, and that will mean that the whole global economy could get a big shock, and then the growth will come down. So in view of looming global growth shock, of course, you overweight REITs, because REITs, you might benefit from lower interest rates, and also because REITs are a bit more shielded. Even though global economy might slow down, but I think the landlords are still going to charge you rent, and it won't impact the Singapore companies as badly as the rest, or manufacturing or the cyclical companies. That's what we mean by overweight REITs. In terms of some of the events, the big news will be the US core PCE inflation. That's the Fed's favorite gauge. We have a lot of events to watch. On the Saturday, as usual, on the 5th of April, we have our usual Singapore stock and strategy, stock picks and strategy for the second quarter event. And then the US is on the 10th. Some of the corporate insights webinar, which is open to everyone, we will have some this week. We also have Paragon REIT. As you may recall, they just made a general offer. So if you want to know more about the offer, you can dial in for that. You got VinFast, you got CLCT, Capital Land China Trust, and LHN, and of course many others. Feel free to dial in. Next slide. This is just to show you the decline in the bounce in property sales. So if you look at the chart on the left, I mean, this could be the chart you want to play prop next, the bounce in momentum, right? This kind of vertical spike in property sales. So this is, I guess, real estate agents will benefit from this vertical spike on the chart on the left. So property sales, the last 2 months was almost 40% of last year. So the momentum is still very strong for property sales. The prop next is guiding 8,000 to 9,000 unit sales, but most probably could hit their upper end 9,000. Next slide. This is just to show you China property. So the blue line is the space sold, not the price, just the amount of space sold. You're starting to see it start to stabilize. So this is the last 12 months amount of space sold in China. So you can see that it's starting to stabilize. The space completed is collapsing. So what it means is construction activity is collapsing. So of course, this is not good for the economy. Like we mentioned before, then there's less furniture sold, less cement sold, less everything, less electrical goods, because less and less property units are being completed. The one on the right is just to show you China's retail sales. It's not robust. I mean, just moving sideways, but at least it's not collapsing. But anyway, so in China, I wouldn't say the economy is bouncing back very strongly, just stabilizing. Okay, I think thanks everyone. Can move on to Q&A. Thank you.
Okay, thanks, Paul. Wait, give me a minute. Okay. Yeah. I'll start the ball rolling. Quite a few questions on banks. Okay, just the first one here is about iFast. Not really a bank, but yeah, iFast. We don't cover iFast, but the question here is iFast has been persistently sold down in recent weeks. Why? Any comments on this counter? Yeah, there hasn't been really any news to point directly at why iFast has been sold down. If you really look at the coverage on iFast, right, the other analysts, the consensus is that it's very strong. A lot of them have increased their target prices as well. So I think that the long term, it's quite healthy, because now they're really trying to diversify, not just do wealth management fee income. They're moving to the bank. But I think at this point, right, it's a bit of a teething stage for iFast, because they have just only proven that it is not loss making anymore. The banking sector segment, right? It's not loss-making. But how much can it contribute to the earnings? It's really unproven, right? If they continue on this track, maybe it will contribute the 10, 20, 10% or to their earnings, their bottom line. And how much can it really boost their earnings? It's hard to say because they are only just taking deposit and giving out some loans. So that's the issue, I think. And the reason why it has been sold down, it might also be a bit of profit taking because it hit a new high. So it might be a bit of profit taking from some shareholders and investors. So that's probably the reason. But if you look at longer term, it's quite positive that they are really trying to move into the banking side, not just focus on fee income, because that's where they see that, and also, their whole outlook on being a global company, right? Instead of just, focusing on like each geography. Yeah. I hope that answers that question. Okay, another one about so this is more for the banks. With the impending interest rate cut impacting SORA, do you reckon NIM to be negatively impacted if the narrow spread between SORA and CASA? Yeah. We do definitely expect that NIM will be negatively impacted going into 2025, right? So it's not just our forecast, but also the banks have also guided as such. All three banks have guided the same, that NIM will decline from the levels that we are seeing exiting, or more like entering into 2025. So the exit NIM for, let's say, January, right? They do expect at least quite a few basis points decline going in for the full year 2025. So yes, to answer your question, will be negatively impacted, but what will offset that negative impact from the declining rates will be the loans growth. Earlier I covered a bit on the loans growth, and based on at least on the MES data that we have, as of January, it's very healthy. It reached a 28-month high. So we are looking at mid-single digits, even at the start of the year. And this is, this is even before more rate cuts come in, and we are seeing even immediately that there is some sort of impact, a positive impact on loans growth. So with loans growth going up, but NIM going down, we believe that net interest income will remain relatively stable because some of that NIM decline will be offset by the loans growth. So it's a bit like the margins were compressed, but at least your volumes are growing, so you can sort of like maintain their net interest income. But then again, for the banks, it's not what is boosting their earnings won't really be net interest income. It will be the non-interest income, so things like their wealth management income, fee income, and trading income. These will be what is really boosting their earnings growth. And I think going into that, there's two more questions that are quite related. So one is asking do you recommend to accumulate Singapore banks even if their current valuation PB ratio is quite high, above their historical average valuations? And also, what is the top pick for the banks? I'll go to the top pick first. So top pick, earlier I did mention it was UOB. Really because UOB, we do expect the highest earnings growth, and also their dividend yield is also very high. Highest amongst the three banks, at least on par with DBS, right? This is inclusive of the special capital distribution dividend, right? So on top of having a strong earnings growth of 12%, which is what we are forecasting, but also the dividend yield is also very high, and also they are trying to diversify into different areas, like not just Singapore, but now they have finally consolidated their city assets into the ASEAN region, and also out of the usual commercial bank that everyone thinks UOB is, but now they're trying to diversify into retail, into like credit card, into fee income, wealth management. So we believe that UOB is our topic due to these reasons, and also that they will probably be able to continue paying out the special dividend if they want to lower their CET1 to the optimal range of 14%. And to the other question, you recommend to accumulate Singapore banks. Yeah, so PB is just one of the ratios. You look at the historical average PB, I think DBS is really the one that is way higher. If you look at the other two banks, they are still below that average line. You know, PB is also one ratio, but you look at the other factors like ROE, you know, dividend yield, earnings growth. We believe that, you know, all these factors, you know, sort of offset the fact that the PB is a little bit high, right? And that the banks still have some room to grow. And also, you know, the dividend yield being so healthy, 6.1 to 6.5% for a bank, right? It's very hard to pass up. And it's still very attractive for the banks. Yeah, good question here. On the why is DBS affected by the 15% global minimum tax while not the other banks? Yeah. So for DBS, their average tax rate before for 2024 was around 12.5%, right? Whereas the other banks were around 14, you know, mid to high 14%. So for them to bump up to 15% is not much of a difference. It won't really affect them. But for DBS, the question you're asking, why is it so low, right? It's because they did get a lot of tax incentives and in this, you know, managed as in Singapore. So they were able to sort of lower their tax. But with the new global minimum tax kicking in and the BEPS 2.0, you know, they won't be able to get these tax incentives anymore, which is why they will be bumped up to that 15%, and it will hit them by around $400 million Sing dollars. So this will negatively impact their bottom line, their PATMI, and you know, we will probably not see any earnings growth in 2025 for DBS, which is also why DBS is not not our topic basically, and why we chose UOB. Let me just look through again to see if there's any more questions left. Yeah, I've answered this one about which is the better buy, which is UOB. I think will DBS drop back below $40 if rate cuts start to hammer? I don't think that it will drop that much, but it's really, you know, share price is very hard to say, you know, will it drop back or drop up. But then again, you know, rate cuts, like I said, right, it's one factor, and it's a double-edged sword. While it will impact their net interest margins, the loan growth is picking up, and we are seeing very healthy loans growth. So net, there won't be much of a hit to the banks. Then again, if you look in a bigger picture, when rate cuts do come in, right, the appetite or the risk appetite and the investor sentiment will shift towards fee income. So a lot of those, you know, customers that are holding out on say let's say they say, oh, I want a better fixed deposit rate, right? So they still put their money in fixed deposit. The banks don't earn a very little, or there's very little margins on fixed deposit, right? If more rate cuts come in, then these investors or those that are holding out will move towards let's say investment product with the same bank, right? And you know, they are also trying to push quite hard. If you don't realize that recently, maybe you get more calls from the banks, you know, asking, oh, you want to are you interested in this investment product or whatnot, right? So that might be a positive factor if rate cuts do come in. And we also believe that the fee income will be the key driver, at least for the banks for 2025. Oh, sorry, where is it? Yeah. Yes, okay. Is DBS, very good question here. Is DBS able to fulfill their dividend and capital return commitments promised to us even with the 15% global tax hammering them next year? Yes, they will. That was one of the questions that were asked to them, and they are okay with it because they are willing to go over what the other two banks are giving. So they're giving 50% dividend payout ratio. But with DBS, they say they are not looking at dividend payout ratio. They are willing to go high. So they can go up to 70%, you know, 70+% kind of dividend payout ratio. And they have the capacity to do it, right? Because their capital is so high, right? They have so much excess capital. So even if with this global tax hammering them, they are still going to be making a good profit. It's not like they are suddenly going to make a loss, right? They're just not going to. The growth is just not going to be there. But if you look at it year on year, the growth, the earnings will still be maintained at roughly the same level, even with this tax hurting them, right? And they will still be accumulating capital even while giving this back. So we do believe that they will still be able to fulfill their dividend and capital returns. And on top of that, they might be able to give back more. So DBS is the most aggressive in saying how much they're going to give back. And they have really given back. They started really giving back more earlier than the other two banks, right? Before that, during their investor day in like 2 years ago, they said that they'll give this incremental increase every year, and they are sticking to the incremental increase every year, right? They're not removing it on top of giving back more capital. And they said that they can, if it allows, and you look at their capital again, if there's enough capital, they will just continue with giving this. Yeah. But then again, just to put a caveat, that was what the old CEO mentioned, Piyush said, right? If the new CEO coming in, I'm sure that she did say that she will continue with what he has mentioned. But then I think the next quarter results will be the best indication, because she will be by herself this time, right? Piyush won't be sitting there with her. So this will be really the best indication as to where she is going to head towards, and if she's heading towards the same direction as the previous CEO. Yeah. There's one on the HSBC Hong Kong SDR. I don't really have any comments for that, but again, for dividends wise, I would say the Singapore banks are now really one of the most attractive. If you look at it, right, they will probably hold these dividends for at least 2 years, right? Based on what they have stated, what they have announced, is at least for the next 2 years. So 2025, 2026. We'll probably see this healthy dividend of 6+%. And from what we have calculated, right, for them to even reach their optimal CET1 ratio, which all of them are saying is at 14%, right? Giving this back for the next 2 years won't be enough to lower CET1 all the way down to 14%. So we believe that there's still even more room for them to continue giving it back for, let's say, another 1 or 2 more years. So all the way until 2028, right? Even up to 2028, we believe that they have the capacity to do it as long as their earnings maintains stable, because there will still be accruing capital if earnings is healthy. Yeah, so we believe that the dividend play, I would say the Singapore banks are really very healthy if you want to get a bang for dividends. Yes. Okay, I'm not too sure about this. This is, I think, some operational, but asking about SDR holder entitled dividends. I think we have to check with that, or if anybody knows the answer. Yeah. I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Thanks, Glenn. I guess I'll take the Apple question. So Hannah, what's your view on Apple losing 1 billion annually on streaming services? I would say that's not entirely surprising. Because streaming industry itself is a money-losing business. Like, you really need to pump in a lot of money in the beginning in order to see profitability. So even Netflix, they being the clear industry leader, they took years to become cash flow positive. Close competitors like Disney and Paramount, despite they have really strong subscriber growth, they're still losing money right now. So I guess the first reason is Apple, they can afford it. Their services segment generate like 80 billion plus revenue per year with very high margins. So losing 1 billion for them is really just a drop in the bucket. Unlike other standalone streaming players, they are not really reliant on the profitability of this segment alone. So they can totally afford to lose 1 billion per year. I guess the second reason is just it's more like a strategic investment. So they're not really about direct profitability. It's more about enhancing their ecosystem. So they kind of lock in and keep users engaged within their devices and services. So in a sense, it can, in return, boost their hardware sales, which boils down to pushing people to buy their iPhone, iPad, and Mac. I guess further down the road, they can also introduce like ad-supported tiers like Netflix if they want to boost profitability. But overall, it's not very surprising. It's just a very strategic investment move for them. Yeah, so that's all from me. I hope that answers your question. I'll pass my time to my colleagues.
Yeah, thanks, Helena. I'll run through some questions. What is the outlook on Daiwa House 46 Trust, Digital Core, and Capital DC REIT? Yeah, so for Daiwa House 46 Trust, their results were affected by the FI results were impacted by the weakening yen. But the good thing is that we saw some if I'm not right, 5% positive rent reversion for the renewed leases. So that is quite a positive sign considering the leases are in Japan, and usually Japan the renewals are flat and they do not have much rental escalation as well. In fact, zero rental escalation during the course of the lease. So if they're 5%, it was a positive sign, but overall Daiwa, they still are impacted by the fact that interest rates in Japan are likely to continue rising, and they will be hit by higher interest rates as well. And they do have some leases that are expiring in the first half that have not been renewed yet. So that is also another headwind for them. Yeah, so that is the outlook. There's some outlook I have on Daiwa. Digital Core REIT. For Digital Core REIT, their Linden Hall lease, or rather, is going to be vacated. So there will be some rather DPU decline there because of that. But for the other portfolio, like the LA portfolio property, we saw some strong leasing. Like the rental reversions are very high also for the LA renewals. So for Digital Core REIT, basically in this year, we expect some slight decline in DPU. And as the Linden Hall DC gets filled, then in FY26, we are expecting DPU to recover. So there will be some weakness this year for Digital Core REIT. Yeah, for Capital DC REIT, there's quite a few questions, but for Capital DC REIT, the outlook is that Singapore data centers, the co-location, especially for the SGP4 renewal this year, we expect it to be around high double digit, like 30-40%, similar to last year's reversion for the co-location data centers in Singapore. So that is a plus. And but you have to take note that next year they will have next year's numbers will not include the DXC settlement that FY 2024 they had 11.2 million that was spread out across the year. So there'll be an absence of that. So likely DPU might be affected as well. And they're still not getting rents from the China data centers also. So that is also another negative for them. And for Capital DC, just a reminder that they just had equity fundraising to raise $1 billion dollars. So that was about over 20% of the issued share capital. So there are a lot of shares in the new shares in the market, and as a result, we also saw some selling. So there was also another question, why there was a sell neutral call on Capital DC. Yeah, so that's also another reason. So for Capital DC, yeah, the shares will be overhang, but the positive is that the Singapore data centers co-location will likely have some strong reversions in 30-40% as well. Yeah, the other countries, yeah, maybe flattish or to slight low single digit reversion. Yeah, that's our expectations. Do you expect Lady Gaga concerts in May do you expect Lady Gaga concerts in May to be okay, I'll just get the gist of the question. In May, will there be upside for the REITs, especially hospitality, retail, hotel, which should accumulate? Yeah, so for Lady Gaga concert, in fact, actually the demand from what I see is not as high as, definitely not as high as Taylor Swift. So even if you log into the Ticketmaster account to buy tickets now, right, I still see some tickets. So it's actually not sold out yet. So good luck to those scalpers actually trying to sell the tickets resale. But basically the aspect, I mean, mainly because it's exclusive to Singapore. So those in the region in Asia who wants to see Lady Gaga, they will not have problems coming to Singapore to watch the concert, and as a result, they will definitely spend on retail and hotel and hospitality as well. So we still do expect upside for the sector, like hospitality, like occupancy during the period to increase. Yeah, but that's mainly from the fact that it is exclusive to Singapore concert. So that is slightly different to Coldplay, where Coldplay maybe there's not much more foreign demand. Yeah, from Kopi because it wasn't an exclusive. So Kopi they perform in Southeast Asia as well. So yeah, so that is my view basically. But for visitor arrivals during that period, definitely we think will be higher than last year. Because in May last year, I don't really recall any significant events off the top of my head. Yeah, so year on year likely higher hotel occupancy and the increase in visitor arrivals will likely boost retail spending for those days as well. Yeah, so for which REITs to accumulate, we have FEHT, Faiz Hospitality Trust. So that is a pure play Singapore REIT. So that will they'll benefit fully from Lady Gaga. Class they'll benefit less because they are geographically diversified. So just a smaller percentage, like 10%, yeah, around 10% only. So yeah, so we have buy calls on both. Pertaining to the disposal of Toh Tuck Lane property by AMC Perry, how much will the DP be affected by the loss of the rental income from the property? Yeah, so on a gross revenue level, the Toh Tuck Lane property, it accounts for about 2.2% of the GRI. So DP will not really be significantly impacted by that divestment from the loss of income. But the positive from that is that this particular asset, the disposal was at or rather I don't think it's complete yet, but the news is that it is 32.5% a premium to valuation. So they'll have some divestment gains there. So they will probably use that to reinvest into the portfolio. Yeah, so I don't see any problems from this disposal. Yeah, it's actually a positive sign because they have some significant premiums or divestment gains from this divestment of the Toh Tuck Lane property. Yeah. Please comment why neutral for Keppel DC and accumulate cost for Suntec REIT. Yeah, so I've already commented on Keppel DC. I already explained it. The Suntec REIT, I'll leave it to Mel. Yeah, another Lady Gaga concert performance in SG within Asia. What are the beneficiaries? Yeah, hospitality sector, retail as well. Has that already been priced in? Yeah, so the impact from Lady Gaga concert will not be as significant as Taylor Swift. So it's only a few days. So it will improve the performance during those like maybe a week or 2 weeks max. Yeah, so it won't be really significant from the full year perspective. Yeah, it will likely just help with the second quarter results. What is your view on Mint, FCT, CICT? Mint seem to be lagging the recent REIT rally. Is it worth consideration? Yes, for Maple Tree Industrial Trust, they have some known vacates upcoming. 3 properties actually. So yeah, it's unlikely that they will be able to backfill that quickly. So there will likely be some downtime. So in my perspective, I think that has been priced into the share price as well. So as a result, the main share price seems to be lagging. Yeah, so that is still the weakness for that. So if they can release that, yeah, no, there's another follow-up question to that. There's no updates for now. So likely they will have some more updates during the next first half 2025 or is it full year results, yeah. So we will have some updates on that during the full year results for Mint. Yeah, FCT. What's your view? FCT, we still we have a buy call on FCT. We still favor suburban retail because of improving visitor arrival, so that will help. And things like the RTS, as we think will benefit FCT, especially since it's likely that more Malaysians will come to Singapore, and when Malaysians come to Singapore to work, they will likely have to spend as well. So and suburban malls are the place where it's likely that they will end up renting as well, to living or yeah, so it's likely that they will benefit when they spend like on F&B at all these suburban malls, especially. Perhaps they will not buy things like fashion here, but yeah, F&B will benefit. So that will also benefit FCT. So yeah, we have a buy call on FCT. Their occupancy cost is still below pre-COVID averages, so there is still potential for positive rent reversion as well. So we are expecting high single digit. And the fact that suburban retail has really very limited incoming space as well. So FCT will benefit. CICT will also benefit from the low incoming retail. But for CICT, we are expecting mid to high single digit as well for both their suburban and downtown malls. Office might be a little challenging, so perhaps flattish to very low single digit positive rent reversions for CICT. But for CICT, the portfolio remains very relatively stable, with the majority still in Singapore, so valuations are very stable for CICT as well. Yeah. Yeah, that's our view for those three counters. Any updates on Maple Street Industrial and Data Center property? Yes. So actually there are no updates and on the vacating properties also. Yeah, no updates. We will update when there are any new developments. Yeah, how do REITs typically perform during US slowdown? Yeah, I think Paul mentioned this earlier. Basically for REITs, we see it as more a defensive play because even in a recession or like COVID, for instance, the tenants still have to pay rent. But the landlords perhaps might give some small incentives, like maybe a rent free for perhaps the very weaker tenants, for instance, or like if the tenants are really like for instance for retail during COVID, some of the landlords they gave the retail tenants some rent free period, so there'll be some weakness there. But yeah, other than that, the tenants will still have to pay rents, so they'll still collect income. And usually in a recession, the Fed will be forced to reduce rates as well. Like we saw in COVID, during the COVID period, the Fed just slashed rates to basically zero. So if that happens, the REITs definitely will benefit from the lower interest expense as well. So that will benefit REITs. So yeah, so usually REITs should perform better as compared to the rest of the market during a US slowdown. What are the main reasons for recent REIT share up in SG market? Yeah, I think is my view is possibly the expectations of more rate cuts. Like recently we saw the market is pricing in 3 rate cuts. From just a month ago, the markets were pricing just 1 or perhaps 0 rate cuts. Yeah, so I think that is one of the reasons. And we also saw the yields really fall, the 10-year yields. So yeah, that's possibly one of the reasons as well. Yeah, I think I'll hand over to the rest of my colleagues first. Thanks.
There's one question on China tech stock. So will the China tech decouple from the US tech? I.e., when US tech starts to fall this year, China tech will appreciate strongly in price. I wouldn't say they will appreciate strongly in price. Historically, the correlation remained pretty high, so they tend to move in tandem with the US tech stocks, and global liquidity usually impact them both the same way. But I guess what might set them apart is the policy support for China tech right now is much better. So unlike US tech that face a lot of regulatory problems, China now is showing signs of easing its regulatory crackdown. So Beijing is trying to revive the private sector confidence, which could definitely help Chinese tech stocks. to outperform in the short run. And also, if you just look at the valuations, they're typically much cheaper compared to US techs. But also bear in mind that China's economy right now is struggling with a lot of weak consumer spending and deflation risk. So that can also limit the upside. So what I would say is they might not crash as hard as the US tech in terms of a downturn, but a strong rally when US tech decline is unlikely. I hope that answers your question. I'll pass my time to my colleagues.
Uh,
Um,
maybe
okay, go ahead.
Lucas, yeah, thanks. Sorry, hold on, let me find. I have I think 2 questions here. Give me a minute. Let me cannot find it suddenly. Okay, yeah. Okay, yeah. CK asked another question. Not really a silly question. It's a good question. Asking why would an organization want to give away so much money? I think this is referring to the banks giving back so much capital, right? Isn't money good? Yeah. Money is definitely good. Yeah, but money is also good for the shareholders if you think about it. So that's one of the ways to look at it, right? Is that they are, trying to give back to the shareholders so that they shareholders and investors will feel that, okay, now dividend yield so high that it's a better stock, right? And if they do that, then the share price might go up. So that's one of the ways to improve relations with the shareholders. And I guess, but the most important one, at least coming from the banks and what they can control, is that by giving back the capital and reducing the excess capital, right? They are able to improve their ROE because if they hoard so much capital and growth is not really there, right? The net income or the PATMI growth is not there, then the ROE will just if they continue to increase their base but the top is not increasing, then the ROE will just continue declining, right? So that's one way to look at it. Why would they want to return? So by returning, if let's say the net income is growing at a slower pace but they are reducing the denominator, then they can actually show that the ROE is growing. They can boost the ROE. It might not be sort of inorganic kind of boosting ROE. And also, by holding so much capital, most banks will hold the capital because they want to grow their loan book. But now the loans growth is so slow, they're not able to really do that. So that's why they're giving back. So even the most I would say prudent bank, UOB, previously they always said that they want to hold capital so that they can grow the loans. But even then, now they also have too much capital and they're also returning it back because they're realizing that loans growth while it's improving, it's still it's not as high as for them to need so much, right? So which is why they're also trying to just reduce the excess capital that they have. Yeah, hope that answers your question, CK.
Yeah, Glenn, Glenn, you want to link the ROE to valuations?
Oh yeah. So a higher ROE, because our valuations are also based on the ROE of the banks, right? So by having a higher ROE, it will also increase the price valuations of the banks that we have, of the share price, right? Well, I think that's what you're trying to say. Yeah. So basically, all of this is linked by giving a higher ROE, then the ROE will also increase the share price valuations based on our models, of the bank's share price. So that's also another reason why increasing ROE is so important for the banks. Yeah. Sorry, forgot to link it back to the valuations. Yeah. One more one here. Banks, in worst case, how will Trump affect earnings and price performance of local banks? I think I'm referring to the Singapore banks. Yeah. So in the worst case scenario, I would say, his policies and, especially the tariffs, it could have a slowdown, like an overall slowdown. And what will happen is that it's just an economic slowdown, right? That on a broader base. And also one thing is that, it might impact their fee income and their investment banking. But thankfully for Singapore banks, investment banking is a very small portion. And also it could increase their provisions and allowances. So this will sort of boost their bad debt. right, increase their bad debt. But at least for Singapore banks, like I mentioned earlier, like much earlier in the presentation, I did say that Singapore banks have quite a healthy management overlay. So they have been, keeping all this in case this scenario happens again. So I think they learned from COVID where, suddenly their allowances and provisions and all shot up, right? And you saw their credit costs increase drastically. But now they are learning that, okay, maybe we should hold back some of these so that we can let it go in case specific provisions come in too high, and they can release general provisions. So if you look at it on a net level, it is still within what they're guiding, right? So that's how they play with that, with the provisions level. Those general provisions is something that they can sort of control, and they can release more, or have some more write backs basically. So that's why that's how we believe that they are be able to control the allowances. Yeah, but of course, in a worst case scenario, then whatever they have set aside is not enough. Fee income is also going down. Then net interest is also not growing. So in the worst case, of course, banks won't be the only one hit. Basically, the whole economy will be hit. Yeah. But that's how specifically to answer your question, how the banks will be affected. I think that's. Oh, yeah. There's one more here. Any thoughts if OCBC UOB will follow DBS in giving quarterly dividends instead of semi-annually? Yeah, interestingly, this question was asked, right? I can't remember, was it UOB or OCBC, but someone did ask the management, like the question was raised, like, hey, why don't you all give quarterly instead? Yeah, and I think it was UOB, I remember. Yeah, and UOB management was like, no, we won't. Yeah, so highly doubt that they will change, suddenly from giving like half yearly to quarterly. Yeah, to them it's not a reason to change and to just follow DBS. Yeah, so I don't think they will follow suit to give quarterly dividends. I think just maintain what they've been doing for the past few decades, which is to give sort of a half yearly dividends. Yeah. Okay. Yeah. Hand it over to Mel. Thanks.
Thanks. I'll take the Suntech question. Why is it neutral? Why is it accumulated for Suntech? Will the rest of the REITs help by? Basically, the outlook for Suntech REIT is very muted this year. Like, overseas performance continue to be a drag. Like, its Australia assets, they're still like taking longer than expected to backfill the vacant space. And for the Melbourne office market, incentives are still elevating. Like it's around 30% of the total income. Yeah, and for the Singapore side, although rental reversion is still resilient, but it's actually like moderating from the high last year. Like for its retail side, they achieved around 20% last year, and it's going to be at around 10 to 15% this year for the retail side. And because of the supply influx for office market in Singapore, rental reversion is only expected to be at around high single digit compared to like a mid-teens last year. Yeah, that's why we give Suntech rate a cumulate. Yeah, hope it answers the question. Why Nanchong doing well and Marco Polo, Pacific, Radiance, and Samudra was all not moving. Basically for Nanchong, is they do say like there's a severe shortage for offshore support vessel like a OSV, and it just they are at the beginning of the upside trend, up cycle, and the cycle has just started. And Namchong is also well positioned to be benefiting from from this upside trend since they are increasing their vessel supply. So they added in another like around 6 small new vessels. Yeah, so this will like directly benefiting their earnings in this financial year. And for Samudra, on the other hand, like because they are likely to benefit from like all sorts of market volatility, like for example, the Red Sea conflict. Yeah, but at this time they do see like our shippings return to the Red Sea. And it's just similar to like all the other shipping stocks. Market are worried about the 1 million fee charging for the Chinese ships. Yeah, but Samudra is confident that they can pass it on to the end customers. Yeah, I'll leave Marco Polo and the Pacific Radiance part for Paul. And some question on Yangzijiang shipyard. Is there any further downside fundamental factor for Yangzijiang, and what's the view for Yangzijiang? Yeah, so basically the sell-off was because of the up to 1.5 million fee imposed by US on Chinese ships. Yeah, but again, like Yangzijiang feel it's easy to pass on to end users, translating to $100 per containers. And yeah, the share price volatility probably will just continue till further update on the issue. And we do believe since they guided like a 6 billion order book for this financial year, we believe like highly likely they'll just revise it up like previous times. Yeah, however, like revenue for 2025 should be like pretty flattish year-on-year since the capacity and workload are pretty much like expected to be similar to FY24 level. Yeah, since like their yard is already running at full capacity. And for some downside fundamental factors, we do saw like Yangzijiang has been losing orders to Korean shipyards because like they do offer earlier delivery slot and also like cheaper price than before. The delivery slot is like 6 months ahead of Yangzijiang's delivery slot. Yeah, and they're also cutting down their price. And there's also like more than 400 new vessels entered to the market last year, and also container ship rates are declining from the peak. Yeah, so we do believe we probably already reached the peak of the this cycle. Yeah, so this remain a downside risk for Yangzijiang shipbuilding. Yeah. Yeah, hope it answers your question. I'll hand it over to Paul, probably. Thank you.
Yeah, yeah. Thanks, Mamel. Yeah, any container rates are down almost 40% this year. So it's going to hurt. The worst case is some of their customers don't take delivery of the container ships. Yeah, and then let's move on to questions. Hi, Paul. Just curious on your guesswork for 2nd April reciprocal tariffs. Do you think it'll be better or worse? I think it could be better because I think because expectations are now so worried and so much uncertainty. So when the news of the reciprocal tariffs come out, there might be a bit of a relief rally. But again, I'm not sure how much relief really going to get from the US because the US is only down, I think, 3.6% this year S&P. Yeah, and it's trading like 26 times PE. Yeah. So even there's a relief rally, so I think it's going to be quite muted. But I think the market might celebrate that it may not be as high as expected. But again, I mean, trying to guess what Donald Trump's going to do is almost a fruitless thing. About that's my own view because I think everyone is so the expectations are everyone is so worried right now. So I think maybe it could be better than expected in a very near term. Then you have to watch how the other countries retaliate. Hi Paul, it's good to buy. Our scene losses have narrowed. Could it be a potential? I'm not sure potential multi-bagger, but what has happened is that for our scene, which has I think 2 big dental hospitals in China, what happened is that the regulations have changed where I mean this is China, so this is what the management said. There used to be the smaller clinics used to get also some government insurance, but that has stopped. So the government insurance has been focused more on the big hospitals like an Alcin. So I think that is helping. And multi-bagger, I don't know, but I think a turnaround is probably underway for them. What's your take on Q&A announcement this morning on EM2? Yeah. Sorry, I think I totally missed that. So actually, the earlier announcement that I mentioned in my presentation was a MOU, and you know MOU is virtually and you agree to do something. That's it. I mean, it's nothing firm, but I think the announcement today was that the agreement is finalized and it's for 1,100 clinics, so it's definitely a positive. The unknown now is to see whether can they get traction and then to see what is the revenue opportunity. I mean, you can do some kind of envelope numbers with $2 times 1,100 clinics, every day maybe 2 clinics, and can do some numbers there. But again, all these are really just assumptions. Until the thing is rolled out, then you will see how much upside. But again, this is there can only be upside because they are not contributing anything, and market doesn't really know how to price this in. But if it really takes up, then this would be the upside catalyst for them. Because right now, even if if you assume $2 or $3 per usage, we're not even sure what is the take-up rate. Yeah, so we need to see, but this is definitely a positive for them. Is there a huge upside for Sembcorp strategic review? I also scratch my head. Where is the upside? They want to sell China, but everyone in China, every foreigner in China is trying to sell things in China. So for Sembcorp Industries, there are 3 buckets. There's renewable, which they're not going to sell because they're actually growing the renewable in China, in China and India. They might of course then the next one is the legacy, the usual gas power plants, which they're not going to sell in Singapore because that's where there's still growth coming in, and they just bid it. Maybe they want to sell Myanmar, but of course nobody wants to buy there. The next, so there's 2 parts of the business. The third part of the business is the land, which they are selling anyway. So I'm not sure where is the opportunity. What is the non-core operating, which they are not looking to sell, which I don't see that. I mean, yeah, I'm not sure where is the upside. I so scratch my head. Yeah. Why is Grand Venture quite a bit down quite a bit after good results? My guess is the valuation is quite high. I think my last check, I don't hold me to the numbers, but I think it's probably like high 20%, almost 30 times PE. The stock is up 40% the last 6 months, and the main reason why it went up is because there was expectations they can do a dual listing in Malaysia. But Malaysia market is, I think, performing worse than Singapore. So I'm not sure if you can go and do a dual listing in Malaysia. So the hope was that if Grand Venture was supposed to be the first one to do a dual listing in Malaysia, and then if they can raise new money and pull up the valuations even more, then the rest will also come. Like UMS was also going to do one. I'm not sure AEM also going to do. But the Malaysian market is not doing well now, so I'm not sure what going to pull. What are they trying to pull? Yeah. I don't know what valuations can they pull. Yeah. Hi Paul. Why do you say China retail sales is stable when the February number is negative, whereas the January number was positive? Yeah, I say stable because Chinese New Year effect. So that's why when it comes to January, February for Asia, we normally try to combine them. So year to date is generally stable. If we use a 3-month moving average, which I use is I think up about 2 or 3%. Yeah. So that's what I mean by stable. Thai government repel afternoon alcohol sales. Can this help Thai bev this counter? I don't really think so. I'm not. Firstly, what it means that you cannot buy. That means you cannot go to the 7-Eleven and buy alcohol in the afternoon. I'm not sure how many people want to drink in the afternoon anyway. There is some obviously, but will it actually move the needle? I'm not sure. Like somebody didn't drink in the afternoon, then he didn't want to drink at night. Most probably they don't drink afternoon, they just drink at night. So I don't think it's going to move much. It's going to change much. I mean, yeah, that couple of hours earlier of drinking, not like people are queuing up, standing outside 7-Eleven or like, oh, now I can drink afternoon, I rush in. So I don't think it will be a game changer for them. Yeah. Why Namchong doing so well, but Marco Polo? Yeah, Namchong doing well is also because in Malaysia, there's this thing called Petros. So Petros is like the Petronas equivalent, and because this is Namchong is essentially a Sarawak company, so they are getting more and more contracts from Petros, which is now the Sarawak National Oil Company. So that is one view that people have to, because by default, you have to give, because Sarawak is such a large voting base for the ruling government. So if you want to appease them, you have to give more contracts to Sarawak company. Marco Polo has been a bit slow because they've been building this huge CSOV, which will drag down the earnings for the last 1 year or 1.5 years. So it will only come back in the second half of this year. Pet Radiance, I think people still want to see the earnings. This is just the first turnaround, so yeah. So Samudera not going to move. I mean, the container rates are down 40%. They're also going to be affected. So containers just have to be a bit more careful. Food Empire share price has been rising. What's the catalyst? So I think Food Empire, I didn't go for the briefing. I think my colleague Yik Ban went. He's on leave, but I think they are guiding. Maybe they're guiding for growth again this year. Maybe mid-teens, 14-15% growth this year. Partly because the coffee prices have stabilized, and also Food Empire. If you look at the Russian ruble is up. I think 25% or 30% this year. So against the US dollar, around 25%. So the stronger Russian currency will also help Food Empire, because they sell a lot to Russia, and of course when the currency improves, they can buy more. I mean, in general. Any thoughts on ST Engineering? Good to load up or take profit? I don't think you want to load up. I didn't go for the briefing. You can ask Meow for the highlights. But I think it's a bit overdone. I think the whole it went up because of course we all know what happened in Europe. There's going to be a new wave of spending in Europe, but it may not go to ST Engineering. Yeah, most of it might go to the European companies. ST Engineering is mainly Eastern Europe and Middle East. So for me, it'd be more take profits than rather go and load up now. What's the outlook for HPH Trust now in the middle of a year surge? It can only be negative. I think if there's a trade war, slowdown in trade, then all the ports will be affected. So I can only say that. I mean, there's no way. I mean, China is the only one now has been hit with 20% tariffs on all its goods, everything. So it's only going to be negative for them. Yeah, and then Canada has also imposed tariffs on US. So it's only going to be negative. I mean, yeah. I cannot quantify it, but it's not just US, but Canada is also imposing tariffs on China. Okay, let me answer this one. Last one, I pass on to Darren. When will WeHer receive the proceeds from sale of PBSA? Any news? They need to get the proceeds. My guess, total guess is in May. And I think our analyst is forecasting 6 cents at least. And because if they don't get the proceeds, they can't announce special dividend. So I think once they get the proceeds, my guess is they can probably announce a special dividend. We guess it's probably May. Yeah. Okay, I hand it over to Darren. I think got a lot of questions. Thanks.
Okay, how's business park segment doing for Ascendas REIT? Yeah, so for Ascendas REIT, the business park segment, we saw that the reversions were still okay for FY24, 4.6%. But basically we expect it to remain around low single digit or so. The occupancy also, we expect it to remain around current levels. If I'm not wrong, it is around 80+% for the business parks. Yeah, and the island-wide vacancy for business parks still remain 20+% or so, the low 20s. Yeah, so basically for business parks, the asset has to be well located, like perhaps a near MRT. Those further away from local transport also, the demand is not really high there. So there's some the leasing and the reversions at those further away from local transportation systems also having some are not doing too well. Yeah, so these parks is still that the guidance actually is that it has bottomed, but we don't think so. We still think there will be some more quarters of weakness for the business park segment. Yeah, so that is my outlook. Both Maple Lock and Maple Tree Pan Asia have China exposure, which do you prefer? Actually, I prefer Maple Lock because at least for Maple Lock, it's been guided that there will still be 1 or 2 more quarters of double-digit negative rent reversion, and we do see some signs of recovery. But for Maple Tree Pan Asia, the overseas assets and their China, we don't we personally, I don't really see like the outlook of the recovery is not very clear. So we're still quite uncertain on that front. So yeah, still quite uncertain. So as a result, perhaps both the better of both evils, if you put it that way, it will be Maple Log. Yeah. Which you prefers? fundamentally at current value. CICT or FCT? Yeah, so CICT we don't cover. But FCT we have a buy call. Mainly because of the fact that suburban retail is resilient. CICT also their retail portfolio is also strong. Like from Ion's acquisition, when they acquired it, or rather right now the performance of Ion that after post acquisition is even better than what they've originally underwritten. So that's also a positive for CICT. But for CICT, they do have their office portfolio, which is the growth is not as strong as the retail. Yeah, and going forward, we also expect perhaps flattish to some very low positive reversions for office. So yeah, as a result, fundamentally we will prefer FCT. Yeah, how's the logistics segment of S-REITs doing? Yeah, so logistics segment, S-REITs basically there's a lot of incoming supply. So we've seen the cost of e-commerce boom from COVID until recently only. Like we saw a lot of the logistics REITs having double-digit positive rent reversions quarter after quarter. So we definitely that will have to slow down. We can't be having double-digit positive rent reversions going forward. So if not, the rents will become exponential, right? So definitely will slow down to the single digits. So for logistics in the face of more supply also, more incoming supply, especially for prime logistics space. So we do expect rents to slow. Yeah, how is logistics segment for Mapletree Industrial? Yeah, Mapletree Industrial don't really have logistics. It's more of Mapletree Log that has logistics. Mapletree is more industrial and general industrial, high-tech industrial, and data centers. Yeah. Between Mapletree Log and Mapletree Industrial, which is preferred stock, yeah, we don't really cover both, but in my opinion, I'll prefer Mapletree Logistics because logistics still remain strong, and despite we do see some recovery from the China side. Yeah, despite the fact that still negative rent reversions. Mapletree Industrial, they do have some leases that are up for renewal, and we do expect some downtime. So basically, vacancy at their property. So definitely no income there. So yeah, that is a negative for that. Yeah. Thanks. I think I'll hand over time to Zain now for TA.
Yeah, thanks, Darren. Let me just share my screen for the TA. Yeah, so first question is on ST engineering. So I think for now, possibly a bit of a pullback to take place. As price has went up quite a bit, and also possible some profit taking last Friday on some higher volume over here recently. So short-term supports, it will come back towards like 627 to about 637 this area. Yeah, but in the short term wise, I think as long as it maintains above the 10-day moving average over here, which has helped since the price embarked on this short-term strong momentum, I think it's still possible for the momentum to sustain. Yeah, but for now, maybe a bit of a pullback first. Then for capital investment, I think for now it could continue to move higher. So because price previously broke up above 255, did a back test over here, and then moving back up again, breaking above the 262 high over here. So possibly trading within this short-term uptrend channel over here. I think there could be still some slight further upside. Also because broke above 260 this previous swing high over here. Yeah, so the next level, the next short-term resistance it will hit maybe at 276 to 279 this area. Thanks. Yeah. And for CK infrastructure, I think for this, I think there's a break of the trend. In terms of the range consolidation, $50, there was a breakdown, as well as this confirmed the upward support line over here as well. So the high volume as well, I think we could see some further downside come. Currently price is next support level, I think could be likely to be around $45, $46, which was this previous range resistance. There's also a price gap over here as well. So maybe it does we could see maybe some slight further downside towards this price level. The next one is on Maple Industrial Trust. So for Maple Industrial, I think came back to this trend line resistance over here recently around 210. Could be doing a bit of a slight consolidation over here. So bit of a sideways. I think short-term support could be around 208. Yeah, then next resistance level will be around 214 to 15. So maybe a bit of a sideways consolidation. And for Capital, I think this one a bit of an increased volume higher volume recently, but let's see whether it can sustain at this 688 level over here, which is trying to break above it. So if there's some if price can hold over here, especially above like 680, I think it could be positive for a move up. Yeah, but for now, I think still need some confirmation. Price has been just consolidating for a very long period from January until now. And next up, Samudera, I think nothing too much for now. Just it's quite sideways. Some resistance at 88 cents and support is around 86 cents for now. So maybe just another consolidation range. Volume is also tapering off, so I think could be just sideways for now. For sets, I think could still remain quite sideways, but the downtrend is still holding. Resistance still likely to come around 310 level, which is where there's this channel resistance as well as the 20-day moving average resistance. So it'll be moving sideways between like 302 to 302 now. Yeah. So just maybe sideways, but if 302 breaks, we could see the downtrend extend. Then the next support level will be at 296. Yeah, that's for sets. UMS, I think uptrend is still intact. I think still holding above some of the moving average supports like the 20-day moving average over here, which has been supporting the price at 109 previously, now 110. So we still higher highs and higher lows being for. I think we could still see price move higher. Yeah. Though it's a bit slow for now. Okay, next is Pen United. So Pen United also just moving sideways. I think not much volume recently. So I think just consolidating sideways. Key support is at 60 cents. Horizontal level also this upward trend line support over here. Resistance is around 63 cents for now. So maybe it could do a slight pullback in the short term with the lack of volume to move it upwards. Yeah, so I think for now still just range bound. And for Far East Hospitality Trust, I think overall still the break of trend from this rising wedge previously. Resistance for now will be this 58 cents, the range breakdown level, also at 59 cents, also at this downward trend line. So I think for now, most probably just trading sideways with some short-term support around 55.5 cents from the recent breakout of this level. So I think we just trade sideways between 55.5 cents to 58 cents to 59 cents as resistance for FEHT. The next one is Yang Zhejiang Shipbuilding. I think Yang Zhejiang Shipbuilding looking a bit better. Overall, this could be still in a bit of a bearish potentially because still below this 248, 250, this horizontal level, as well as below this previous trend line as well. Then, yeah, so this could be a bearish fact between 224 to 248. In terms of short term wise, a bit better because it's above the 5-10-day moving averages short term, and is also there's some volume spike on Friday. Yeah, so short term support could be around 235, 236, about there. Yeah, if we can hold the price, then there could be some further sideways. Yeah, for Yang Zhejiang Shipbuilding. For Singtel, I think it's still in a range consolidation, nothing too much, but still positive overall, higher. Still is a consolidation with resistance still holding firm around 342. Price attempted break on Thursday, but we still close below. I think but still positive, higher lows being formed, possibly at 335 last week, another higher low. So if you get another break of 342, I think there could be a real breakout soon. Next key Next resistance level maybe at 348 and 355 for Singtel. So I think this one just a bit sideways but still positive. Okay, Raffles Medical, I think the uptrend is still strong. Over here, break above $1 last week. Also, I think for as long as this one still maintain above the 10-day moving average, I think it's around 99.5 cents now. I think this short-term momentum is still intact. Yeah, then next resistance level to look will be around 104 to 105 previous range resistance, then followed by 107 to 108. Okay, then I'll move on to some of the US counters. Nvidia, I think for now is a bit sideways. But I think if you can break above this 118 level, there could be some slight bounce back towards like 123 again. Yeah. So price 123 will be the retest of the recent highs as well as this blue color trend line breakdown previously. Yeah, so price a bit of consolidation recently. Then for Apple, I think Apple, yeah, price moving a bit sideways recently. I think try to move a bit upwards with the first close above the 5 and 10-day moving averages in the short term. So some slight bounce perhaps, but resistance maybe at 226, the recent breakdown level. And then for Microsoft also moving sideways, price is still holding above, trying to hold above the breakdown level at around 380. So I think if can break above Friday's highs around 392, we could see some slight bounce towards maybe like 400 again. Yeah, so to do a bit of a range consolidation. And, Amazon also something similar over here. Potential break of this trend line resistance over here. So some short-term resistance, it could move higher towards like 199 and 207 in the short term for a short-term bounce. Yeah, then for Meta also retested a trendline support recently as well. Yeah, still holding a bit sideways. So you can move if you can break above the Friday's high around 598. I think we could see some short-term bounce towards like 620 to 630 area as a next short-term resistance. I think all these counters are about the Magnificent Seven. I think you can look at this max the Magnificent Seven ETF to see how to likely go also. So a bit sideways in the short term, but some a bit more bullish momentum in the short term as the price is closing above the 5 and 10-day moving averages for the first time since the pullback on Friday. So we could see maybe a slight bounce upwards. Some short-term return will be around this 48.80 level, which is about 3% upside from current levels. Yeah, then if we test the 200-day moving average, it's about 3.5% upside. So maybe like a 3% bounce for the Magnificent Seven is possible in the coming days. If it sustains the current momentum. Okay, I'll move back to some of the Singapore counters. Oiltech, I think Oiltech could see a pullback. Could see some further pullback here because price retested this swing low 108, then there was a rebound, but possible lower high at 122, which was a resistance and support level, but it was a breakdown, so we could see another pullback. Also, when I look at the indicators, there's also bearish divergence and price was moving upwards. Then this was confirmed with the breakdown recently at 122, this trend line as well. So possibly we could see maybe price test this support 108 again. Then for Rex, I think for Rex, just sideways for now. So currently we're at 0.143, some resistance at 0.148. So a bit sideways. If it breaks below 0.13 again, then it could resume going downwards, maybe towards 0.138 or lower, or 0.135. Since overall it's a downtrend, then possibly just doing a bit of a flat kind of pattern over here in the short term. Yeah, but if it breaks below the 0.143, then you might see some further downside. Okay, then for Thomson Medical, I think overall downtrend, but a bit of a slight bounce in the short term. Also, price if can maintain above 0.044, then maybe some slight further bounce towards 0.048. This will likely be a resistance from this channel resistance as well as the previous horizontal breakdown. So overall, I think since March of last year is about 1 year already, price has been just trading within this downtrend channel over here. So it's just a short-term bounce in this overall downtrend. Okay, then I'll talk about the TA for the 3 local banks. So first up, our DBS. So DBS, I think, doing a bit of a slight bounce recently, but I think we could face some face some resistance around 40 at this current level 45.50 to 46 this area. So with the break of this short-term uptrend channel over here, as well as this was a previous level it was trading in before this came down for DBS. So maybe a bit of a slight consolidation over here between like 45 to 45.50 in the short term. And for UOB, something similar as well. Today looks like a retest of this pricing wedge breakdown. So some resistance, I think for now will be this $38 onwards to about 38.50, this area. Support wise could come from this around 37.30 to 37.60. So maybe a bit of a sideways in the short term. Then for OCBC, I think it's something similar as well. So coming back to some of the resistance level around above 17 to 17.30, this area would be resistance, and support would be maybe like 16.60 to 16.80s. So possibly some sideways consolidation as well as it enters into the resistance area. And then there's a question of Alibaba. Okay, for Alibaba, I think for now the looks like a bit of weakening in terms of the short-term momentum. I think price is trading this ascending triangle. Keep on there's resistance above $140. Yeah, you can see where price attempted to break above 140, it keeps coming back down. Also break of this short-term trend line support. I think it's also the 20-day moving average as well. So I think I will expect some slight pullback in the short term to at least maybe test 125, this next support level. And there's also weakening momentum in the indicators. Okay, then there's a question on the new counter in Singapore. I think for this counter, it looks to be generally very sideways. So recently it went up towards the resistance 530, and it's coming back down. So I would expect price to maybe there's still some selling momentum recently. So we could maybe see price come back towards the lower end of this range, maybe at 410 to 430 this area again. Then it could just do another sideways, which it has done since in the past over here. Yeah. So that's my take on you. Okay, I think that's all for the TA questions, which reached the one o'clock time also. So I think I hand back time to Paul if you have anything to add on. Thanks.
Yeah, thanks. I think we're done. Yeah, so thanks everyone. I think there's one more question under the chat. What's your view on glove industry? I think it's definitely recovering. I think top gloves utilization rate and so forth is improving. But this mainly because the Chinese manufacturers have been shut out of the US. But the worry now is the Chinese manufacturers are setting up base in, I understand it, in Southeast Asia. So you might get this lull period of competition from the Chinese for now. But we worry the Chinese competitors are not going to go away. So that it could be maybe a short-term bounce in the whole industry. But I just worry that the capacity will come back again for China. So that's my comment on the glove industry. Anyway, with that, thanks everyone for your time. I hope it was useful and hope to see you again next week. And do sign up for some of our events for the next couple of days. Yeah, thank you everyone and have a good week ahead. And thank you for your time and questions. Bye bye.